session, as Chris said, is investing during election years. What does history tell us? Just a bit of my background. I grew up and still live in the Washington, D.C. area. Went to University of Maryland as an undergrad and then graduated and then later went back for my MBA. And although I've been in and around the DC area most of my life, I didn't really grow up. My family wasn't really that political. So when I look at politics and investing today, I really look at history more so than the emotional side of how politics can be a very emotional subject and is really today. So as an overview of the session, just did a little bit for you on my bio, but I'll do a brief introduction to Mason so you get a sense of who we are. And then as far as the expectations for today's session, we will discuss market history and we'll look at the S&P 500 because the S&P 500 goes back so far in history that it's a great index to use to track how investments have done over multiple time periods. We will discuss the risks briefly of following market prognosticators, which is fraught with risk. And we'll talk about that from the standpoint of economists making predictions, which will be fairly interesting. We will not discuss the platforms of the candidates. This is not a political discussion. This is more an investment history discussion. And we will not discuss who will win the election. We're going to focus on history and what that tells us about investments. So just a brief bit about Mason. Mason was founded in 1982. We're primarily in the DC area, although we have clients around the country. We're independent. We don't have any products to sell. We sell a service which is institutional consulting to nonprofit organizations as well as managing money for private clients. We've worked with the Schoolcraft College Foundation for about a year now, and we are enjoying that relationship. We manage about $8 billion in assets, and about $4.4 billion of that is institutional nonprofit type work. And Chris has a copy of this presentation. If anybody's interested, we've been listed, featured, highlighted in multiple publications. Although we're a boutique firm, we have been recognized, and we're very proud of that recognition. Most recently listed in Barron's as a top 50 independent registered investment advisor and top 50 institutional consultant. With that, let's get into our session. And what I wanted to start with, and let me say this real quick before we go. If anybody has questions, please enter those into the chat and we'll address those at the end. We've got time at the end of the session to take questions. So enter your questions into the chat and we will address those at the end of the session. But what I wanted to begin with was talking about objectives, your investment objectives, and portfolio construction and diversification. I think if you're thinking about investing in an election year, it's really like investing in any other year, and you have to know what your objectives are and what your goals are for those investment dollars. And if we think about investing, we can think about at the bottom of this slide, we can think about things like our time horizon for those investment dollars. Do we have a short-term time horizon or a long-term time horizon? Volatility, we know markets are volatile depending upon what we invest in, but are we willing to take on higher volatility, or do we not really like volatility that much? We don't want a rocky ride through the markets. And spending level, what do we want the dollars we're investing today to grow with or beyond inflation, or do we want to not lose purchasing power in those dollars? So with those three things in context, we can think about our objectives. Do we have a stability of principal objective? A spending objective, maybe we're spending out of our portfolio today, or a growth objective. And depending upon what your objective is, it impacts what you invest in. If you have a long-term growth portfolio, you're going to be biased towards equity or equity type investments. If you want to maintain your cash, well, if you want your dollar today to be worth or to be $1 5-10 years from now, you can put it in your mattress or put it in the bank, and you will have that principal will be there, but you may lose purchasing power because of inflation. So you need to think about your objectives first before you invest. And as you're thinking about your objectives and what you want to invest in, you can think about different asset classes that you might choose. This chart is very busy, and it's busy on purpose, but let me take you through it and tell you what it tells us and what we think about with this chart. Each column is a year, and we only went back to 2002 here because the boxes start to get really, really small. And then it goes all the way through September of this year. Let me move this box out of here. Okay, it goes through September of this year. Sorry. Okay, and so each column represents a year, and this is 2002. And each column is ordered by the performance of the asset class, relatively speaking. So in 2002, for example, TIPS, or Treasury Inflation Protection Securities, were the top asset class of the 14 listed in this column. International bonds, intermediate term bonds, all the way down. And at the bottom, you have small growth, which are domestic. These are small growth domestic stocks. In the middle here, or close to the middle, you have a box called zero, and that is zero return. And the zero return box represents the zero line, meaning any box above this zero box were positive performers in that year. Anything below the zero box was negative that year. And these are 14 asset classes. You could have other asset classes in this chart, but these asset classes represent a fairly broad group of individual asset classes that one might invest in. And as you march along the years, if you go left to right, all the way up to 2019 and then through September of this year, you'll notice that there really isn't a pattern. It's hard to track a pattern through these investments, which tells us that the market tends to be volatile. Top performing asset classes today are not necessarily top performing asset classes tomorrow, and vice versa. Your worst performing asset classes today could become your best performing asset class tomorrow. So we think about one way to protect yourself in investing is by diversifying your portfolio, having some plan and some idea of how you're going to diversify your portfolio. Now, as we said on the previous slide, if you are a stability of principal type investor and you're investing, maybe you're saving for a large purchase, a home or a car or something else, you may put that money in cash. You don't expect that to grow necessarily, and that won't be volatile. But for your longer term investments, you know that the markets are volatile. If we look at 2008 and 2009, for example, you can really see this volatility on display. 2008, as we know, we'll look at this on another chart in a few minutes. 2008 was a very negative year. It was the market crash, the real estate bubble, subprime lending, subprime mortgage crisis in 2008. The zero box is here up at the top, and everything else was negative, except for cash. It was the only place you could hide within these 14 asset classes. But now at the bottom, you have, went too far. At the bottom, you have international growth. This is large growth international stocks, natural resources, and international small cap. The next year, nobody probably would have predicted that those three asset classes would be your top three performers in 2009. So the message on this slide is that the market's volatile. It's hard to predict what's going to happen in the future. Although people do try to predict the future, that is fraught with much risk. So let's look at historical performance from an S&P 500 perspective. If you're going to try and figure out how to invest, and maybe how to invest in an election year or how to position your portfolio for the future, it's good to at least know what's happened in the past. The past may not repeat itself, but it typically does, maybe in a different order, in a different way, but we have seen similarities in the market over time. So here's a little quiz, and we'll use the honor system here. You can take this quiz on your own there. From 1926 through 2019, the S&P returned about 10.2% on average over those 94 periods. But how often do you think the S&P returned between 8 and 12% in an individual year? Maybe a lot, maybe not. The answer is just 6 times. Only 6 times in 94 periods did the S&P return between 8 and 12. And that's pretty interesting when you think about volatility and how volatility can hurt us psychologically when we're investing. Because just when the market is ready to be purchased, when things are low, is usually when people feel the worst about it. Again, markets are volatile. And the markets have generally fluctuated very widely. So let's look at individual years within the S&P. And so on this chart, we've got the first year here is 1925, but actually this bar here is 1926. And then we go through 2019. This is 0 here, so we have positive returns and negative returns year by year, year over year. And you can see the years between 8 and 12% are sort of spread out. We've had 3, it looks like, since in about the past 30 years. But they're spread out over time. But the market is pretty volatile. It's up and it's down. This is the tech bubble, the dot-com crash, post-crash. So this is 2000, 2001, 2002. This is 2008. We just saw that on the previous chart, or the chart a few minutes ago. Pretty bad year in 2008. 2019 was a great year, and we know what we've been experiencing year to date this year. So message here is that the market, again, is pretty volatile, but also it's mostly up. One thing you see on this chart is mostly positive lines. So year over year, you average a certain return if you stay invested, and you'll get that average return only a few times. That between 8 and 12%, you only get that a few times. But you do have to ride out these highs and lows if you believe in investing and that it's worthwhile over the long term. So if we look at the frequency of returns, now we can look at how often was the market positive. So in terms of, and these are in terms of calendar years. So this chart shows that over those 94 periods, 73% of the time you had a gain. And you could see that visually on the previous chart. Most of the bars were positive or moving up. And 37% of the time you were 20% or more in gain. So you have a good opportunity over time to earn money in the stock market. S&P 500 are your largest domestic stocks, but it is a fairly good proxy for the market overall and in history. And only 6% of the time did you experience a loss of 20% in any one year. We can also look at international stocks. This is now just back to 1970. This is about a 49, 50-year period. And it's fairly similar. Gains in non-domestic or non-US stocks, gains about 70% of the time. We just showed 76% on the previous slide. 20% or more, 38% of the time. Very similar to the previous slide for domestic stocks. And again, about 6% of the time, a loss of 20% or more. So this is shorter history here, but it's fairly similar in the distribution of positive years versus negative years with your international stocks and your domestic stocks. Now, these can be, they may have positive and negative years at different times. They may not be both going up at the same time or both be going down at the same time. Now, if we start to look at longer time periods, it's a little more interesting. So over 5-year rolling time periods, we can see how often the S&P had a gain. Now, when we talk about 5-year rolling returns, we're looking at creating multiple 5-year rolling time periods over this 94-year period that we're looking at. And the way that you do this is you would start with the first 5-year time period that would begin in 1926 and end in 1931. And then you would roll the data that we have, you'd roll that forward 1 month, and that would be a second period. And then you roll that forward a month. And you do this month by month by month, and you create 1,069 rolling 5-year time periods. This is very statistically significant information. And when you pull this together, you see that you have a gain almost 88% of the time over these 5-year rolling time periods, which indicates holding on to your investments is probably a pretty good idea. Now, your opportunity for 20% or more is a little bit less. As you get into these longer time periods, you're going to start getting closer to that average of 10.2%. But over 5-year rolling time periods, a loss of 20% or more, you didn't have it. On the previous slides, we showed about a 6% chance in any individual year that you might lose 20%. And then if we look at rolling 10-year time periods, you can imagine it gets even better. About 95% of the time, you had a gain. 50% of the time, you were over 10%. We know our average over long time periods is about 10.2, so this looks good. And a gain of 20% or more barely ever happened over rolling 10-year time periods. So you might get that 20% here and there, but on the over the long term, you're likely to have a gain if you stay invested, but those big gains probably won't come over long time periods. So now we can look at a little bit shorter time period. This is 1980 through 2019, and start to drill in on volatility intra-year. And that just means the volatility within a calendar year period. So this is the same chart we had before, but just starting in 1980 versus 1926. And here you can see your negative years. Again, the dot-com crash, real estate bubble, 2019, a great year. 2018 was a little bit down. But what you can do here is change the chart and look at the down periods in each of those years. So in each year, you have to deal with volatility. If you held your investments for the whole year, you know you would have a gain. That's 70-some% of the time. But in order to get that gain, you do have to deal with some volatility. So in each of those same years, going back to 1980 through 2019, there was some intra-year loss or volatility on the downside. These up years don't go straight up the entire time. Now, if we stack these two charts, you can see the intra-year loss and then where the year ended up. So a year like 2008 was tough because you had an intra-year loss. You were down close to 50% on the S&P and ended up down 40-some%. I don't have the exact number here in front of me, but you get the idea that even in the up years, you experienced some level of down. And this is where psychology gets into investing. And are you willing to maintain course while you are investing? And investors tend to follow their emotions, which is normal. It's natural for that to happen. I'm just finding my slide flow here so I don't get too far ahead of myself. Hold on one second. Okay, there we go. So what's interesting about this chart, you probably have experienced this one way or another mentally, is that in markets, there's often a period of optimism followed by higher prices in the market, and the market's going up. And then there's elation with that feeling of higher prices. Now, a lot of investors will buy when they feel really good, when the market feels like, yeah, this market is definitely going up for a long time. I'm feeling like this is the time to, I'm feeling like this is the time to buy. But what happens is any natural and normal business cycle or market cycle, the market ends up going down at some point, which leads people to be nervous. And then people become fearful as prices go down. And this is often when people sell because it does not feel good. This is that period in early 2009. We know that March 9th, 2009 was the bottom of the last crisis, the real estate subprime mortgage crisis. March 9th, 2009 was the bottom of that market. And what's interesting about that market or that day is that Wall Street Journal on March 9th, 2009 published an article, and the title was "The Bear Growls Louder," as in the bear market. The bear growls louder, no end in sight, major indices at 12-year lows. So on March 9th, 2009, that was the best time to buy in that last cycle because that was the bottom. But it's when people were the most fearful, the prognosticators were probably telling you, you got to go to cash, this isn't going to end well. And then shortly after March 9th, the market rocketed back, and we know 2009 ended up being a very good year. So after your fear becomes optimism, and you know how the story goes after this. The issue is, and this continues every year, year in and year out, and as an investment person, we see this in every cycle. We get the same questions, similar questions, but they're about different things. In 2008 and 2009, people are asking us why we didn't just invest in bonds. They thought we should just have all bond portfolios because bonds had an historic run. And then we were ready for a bull market in equities. So different markets yield different questions, but people struggle to separate their emotions from their investment decisions, and this happens over and over again. And if you follow that cycle of reactivity, it can really hurt your investment results. So where do we see this? Where can we actually see investors making decisions, sort of trying to time the market? We can actually see it in mutual fund performance, which is interesting. So in Morningstar, based on software used from Morningstar, which tracks mutual fund performance, we can track the actual performance of real investors in mutual funds, the actual performance, actual experience of investors, versus how that mutual fund performed if you had just stayed the course and just bought and held, or maybe you had a better method of buying when things were low. But for the typical investor, they often outsmart themselves. On this chart, we're showing the detriments of market timing, trying to time yourself in and out of the market based on your predictions of the future, or how you're feeling, or what you think might happen near term. So this is a 10-year period that ended at the end of 2019. And what we're showing are investors in domestic equity mutual funds, international equity mutual funds, taxable bonds, and tax-exempt bonds. So 4 broad categories of investments. And again, these are mutual funds. The green bar shows how you would have performed had you invested in these baskets of mutual funds if you had bought and held for this 10-year time period. So the green bar shows how the mutual fund itself did. And if you bought and held, you would have experienced those results. The red bars for each category show how actual investors in these mutual funds did. And this is not to say they didn't do as well because they paid a fee. This is how well they did because they bought and sold. They went in and out of these mutual funds typically at the wrong time and hurt their performance. To the tune of, for the domestic equities, you lost 11% of what you could have had. For international equities, it was 23%. For taxable bonds, it was 30%. And for tax-exempt bonds, 38% worse by timing. So market timing is a tricky thing to do, and it tends to not work. It's hard to predict the future. It just is. And it's even hard for the best minds on Wall Street. So are interest rates predictable? This is just a prediction category. I don't consider economists to be pundits, but when they make predictions, they kind of become pundits for some sort of prediction. And you could do this type of analysis with the predictions of folks on CNBC and other places, but this is a nice, clean way to look at predictions. So are interest rates predictable? This is put together by Davis Advisors, and they have tracked the results of a Wall Street Journal survey that was done between the Wall Street Journal and Legg Mason. And they've done this survey back to 1982. And what they do is every 6 months, they survey the top economists on Wall Street and other economists, other leading economists, and they ask them a whole bunch of questions. There's a lot of questions that go into this survey. One of them has to do with interest rates and the direction of interest rates 6 months from now. So essentially, one of the questions is, do you think interest rates will be up or down from where they are today? So interest rates going to go up or down 6 months from now. And they can track the results of this. We have a lot of respect for these economists. They're some of the brightest people out there. They understand so much of what's going on, but it's even hard for them to make predictions. Let's see how they've done. So the first period was December 1982, and they got the prediction right of future interest rates 6 months out. So the first time they did it pretty well. They got it right. Let's see how they did the rest of the time. Actually, they were incorrect on their forecast. This is through December of 2019. They were incorrect 64% of the time. You would have done better at predicting interest rates simply by flipping a coin. So this is not to say that these economists are not extremely bright. It's just to say it's very hard to predict the future. It's just really hard to do that time and time again. You might get it right sometimes, but it's typically not the case. So let's look at how investors behave during election years. So we at Mason work with, as I said up front, we are not, we do not produce any of our own products. We're independent in that way. So we use or work with multiple mutual funds and mutual fund families, and they have some fantastic research. So I'm going to show some of that here over the next few slides. And this is essentially, now we're into investing during election years. We've looked at history. Now let's look at how investors have behaved during election years. And this goes back to the 30s in some cases. So this is a more near-term study. This one, I believe this is done by Capital Group, which runs the American funds, and they're one of the fund families we work with. This was interesting, and they looked at presidential election years during that year, and then a year after an election, presidential election. And what they found is that they looked at equity mutual funds, which are usually people investing in equities are hoping for their money to grow. If you're investing in equity funds, you may be bullish on the economy. You think things are going to go up. If you're more fearful or you're saving for something for the future, you might be in money market funds. But they found over this 28-year time period, or seven election cycles, that during a presidential election year, most of the money people were investing went into money market funds. This bar is money market funds versus equity funds. Whereas the year after an election, people put their money into equity funds. They felt better, regardless of who was in office. Much less money was in money markets, more went into equity funds. Now we're going to bookend this later and see what would have made the most sense. There's another study that kind of highlights some of this information. So this is a slide from Dimensional Fund Advisors, or DFA, another one of the fund families we use. And DFA has something called the Fama French Total U.S. Market Research Index, where they look at not just the S&P, but S&P, or they look at NASDAQ, the Dow Jones Stock Index, and the American Stock Index. So kind of a broad market basket. And they actually look at the growth of $100 over multiple market cycles and multiple presidents. And as you can see, over time, the market continues to grow. There are some dips, but over time, the market continues to go up. And what they say on this slide is it's natural for investors to look for a connection between who wins the White House and which way stocks will go. But as nearly a century of return shows, stocks have trended upwards across administrations from both parties. The second bullet here says U.S. presidents may have an impact on market returns, but so do hundreds, if not thousands, of other factors. The actions of foreign leaders, a global pandemic like we're seeing this year, interest rate changes, changes in inflation, oil prices, and all of that stuff. So presidents have an impact on the markets, but there are so many other things going on that over time, history shows us that the markets continue to go up. Similar here, another slide from American funds. This is this is a growth of $10,000 in the S&P 500, again back to 1933, and you can see that through different types of presidents, red here, they kept the pictures out, but red and blue over time, markets continue to go up if you are a dedicated long-term investor. So now we'll get a little bit into, so there's one thing if the president is a Republican or a Democrat, how does that impact the markets? What about a unified government? So that would mean all one party across the House, the Senate, and the White House, all one party. Average returns. Now remember, up front, we showed 10.2% average return for the S&P back to 1926, 10.2. So unified government, again, all one party control, based on this American Funds study back to 1933, shows 10%. Now, unified Congress, president and other parties. So this would be the House and the Senate, Democrat, White House Republican, or vice versa, 7.4%. The market doesn't like that quite as much. What the market tends to like the most is split Congress, which is essentially where we are now. Republicans have the Senate, Democrats have the House, and then the president could be on either side in this chart, so 10.4%. So there are some differences depending upon what's going on, but 7.5 to 10.5% roughly. This gets a little bit more into the weeds. How might markets do post-election? This is a chart from PIMCO, another one of our fund families, fund managers. And markets tend to do best under a split government, which we saw in the previous slide. So this shows Democratic presidents 24 times over this time period, 10.9%. Republican presidents 20 times, don't do as well in this example. However, if there's a Republican Congress versus a Democratic Congress, that does a little better. Mixed Congress, kind of in the middle there. Democrat Party, one-party government 17 times versus Republican one-party government. That happened 4 times over this time period. So various different outcomes depending upon who's in charge. But we know that these things change every couple of years with the election cycle. Every 4 years for your presidential elections, every 6 for the Senate, and in different iterations. So these mixes are constantly changing. But remember, our average for the S&P is about 10%. So these bars all rise a little above and a little bit below these lines. This one gets a little more, this is a little more specific on actual presidents back to 1980. And this one you can kind of review the market history here. This is markets more or less have done well following elections, regardless of who wins. And what this shows is the 3-month return of the S&P after the election and the 1-year return of the S&P after the election. This also shows the Barclays aggregate, which is a bond index post-election. But let's focus on the S&P. So if you look at Reagan back in 1980 when he was elected, first 3 months, lost a little less than 0.5%, and the first year was down 3.3. This was coming off an historic high inflationary period, high interest rates, sort of a bad economic period. And Reagan's second term was a little bit better. First 3 months, S&P was up 7. And then the first year of his second term of 14%. You can look at Clinton's first period here, 5.8 and then 9.5 in his second term. Now this Clinton's second term, 96, we're starting to get a little bit into the bull market of the late 90s, which lasted for several years. 96 through 99 were great years. 95 was pretty good as well. George Bush's first year, this is on the heels of the dot-com crash. Second term, a little bit better. Obama's first 3 months in office, we're at the end of this is the end of 08 into early 09. And we know we're coming off the subprime mortgage crisis there, and then on and on. So this gets a little bit more into the weeds of individual years. But if we were to sum this up, I have one more slide here. Let me make sure. Yeah, so if we were to sum this up, and I think this is interesting when we go back a few slides. So we looked at this slide on page 26, and we looked at how people behaved, or how people behaved over the past 28 years during election years, year of and year after. Most people, it seems, become fearful during an election year, concerned about what might happen, and then invest heavily after. But what happens if you invest consistently all the way through? So this is another chart from the American funds, from Capital Group. And this one I thought was really interesting because of what it says about investing consistently. We talked about this early on with staying invested in the market is typically the best way to go. Hard to time the market, hard to time the ins and the outs. You might get part of it right, but getting both sides right is tricky. So what this chart goes through, and I'll break them down for you, this looks at 3 different types of investors. And this is an analysis of 22 election cycles since 1932. This is a pretty long time period here to consider this topic. So they look at this as, the first one is somebody sitting on the sidelines. So this is in the first year of a presidential term, the individual sits on the sidelines and doesn't invest their $10,000. The second year of that presidential election cycle, they put everything in. So they sit out for a year and then invest everything in for years 2, 3, and 4. And then you can see their results on average over these periods. Consistent contribution says that in the first year of an election cycle, the individual puts in $1,000 of their 10, and then every month after that, they dollar cost average in and then hold. So after the first 10 months of the election cycle, they become fully invested. After month 10 of the first year, they hold on through the end, and they end up here with just over $15,700. However, the best, and these two are fairly similar, but the best results of the 3 was if you stayed fully invested. You invested your $10,000 at the beginning of the election cycle. On average, over time, you ended up the furthest ahead in most of these periods. These 2 columns give you the best and worst outcomes of these cycles, so you get a sense of how often these things happen. But overall, if there's a message from this session, it's that your best bet is to try not to time the market. You're better off staying invested, but ultimately you need an investment plan where you have some idea of what you're investing for, what your time frame is, how much volatility you're willing to take on, and then build a diversified portfolio and stay invested in that portfolio. It's very hard to time the market over time. Most people don't do it well. There's very few who can. And those that have timed the market well tend to get it right a few times, and then they don't get it right after that, and you can lose a lot of money that way. So that is the end of the formal session. We have some time for Q&A, so I think Chris is going to come back and see if there's any questions in the chat room. Chris has my contact information. If anybody has any questions, happy to take them after the session.
We will be convening again in November. We'll send you more information about that. But our topic is going to be on tax planning tips for the coming year end. And that will be with Don Kent from Bernstein Alliance. So we'll be sending out information about that. You can register to sign up. And as always, thanks so much for being with us. And thanks for supporting Schoolcraft College. Have a great day, everyone.
Thank you very much. Bye-bye.